All right, so guys, welcome to Thursday, 27th of October. This is Gene on the call, and this is going to be a presentation on BPRs. And this is a live session, but some of you guys are watching the recording right now, and it's going to be added to the monthly comes there folder. Okay. All right, so what we're gonna do is we're going to look for a very random currency. Let's use Swiss franc. And we're going to go out and all right, so today's presentation is on BPRs. Okay, so what is a BPR? Okay, BPR stands for balanced price range. Before I start the session, I want to ask a question in the chat box. How many of you guys watched the video I did on why is this not showing? How many of you guys watched the video I did on I think it was, let me see. Give me 1 second, 1 second. Let me rush and find the video real quick. That was on module 3 of the course. I think I made it available to you guys. And I said you need to watch the video first. Let's see. Training course. That's module 3. Some of you guys watched this video. Impact the interbank price rate. Sorry. Some of you guys watched the video I did on price engineering interbank pricing. Please, if you watch the video, just type one in chat box. I want to know the number of people actually watched it so I can frame today's presentation. I know just some of you guys are new on here and you're concerned that the content you're going through is just a lot. Okay, I apologize, but there's nothing. Honestly, there's nothing I can do about the content. That was what I learned, and you're going to unfortunately have to go through the same process. All right. Let's see. I did, but couldn't get it. Okay, awesome. Makes sense. All right, so today's presentation is going to be on balanced price range. Now, the question is, what are balanced price ranges, and what is the importance of balanced price ranges on your charts, and how do they affect your trading? All right, that's a question we're seeking to answer on today's session. Okay, now when the market is pricing to a point of liquidity, you need my approval to watch. Oh, okay, I'm going to go through. I'll take the email today. Are we recording this? Yes, we're recording this. When there is now, remember the way the market is priced. Okay, the market is designed to draw towards points of liquidity. All right, and those points of liquidity could be in form of old eyes or their liquidity pools or inefficiencies. Now let me clarify something real quick on the call. An inefficiency is a form of a liquidity. Okay, there are two types of liquidity. There's a liquidity pool and then just liquidity by inefficiencies. All right, I'm going to repeat myself one more time. There are two types of liquidity pool. There are two types of liquidity. There's the liquidity pool, and then there's liquidity by inefficiency. When you spot a buy side and balance sell side inefficiency, okay. Come on. Okay. All right. So when you spot a buy side and balance sell side inefficiency, right, in a predominantly bullish delivery or bullish order flow, once you see that the buy side and balance sell side inefficiency is a buy side liquidity, okay, that's a buy side liquidity. So when you see something like this this will be a fair value gap. Okay, that's going to constitute fair value gap. This fair value gap is a buy side liquidity. Okay, so BSL, and that's why if the market is at premium, we can expect the market to trade down into that because that is a buy side liquidity. Why is it a buy side liquidity? It's a buy side liquidity because we've only traded there on one side, on the buy side. Okay, so the liquidity in that region of price is buy side liquidity. Now, if the market is coming off of a discount, let's assume. Oh, sorry, my bad, guys. This is a sell side liquidity. Excuse me, I made a mistake here. Okay, sell side liquidity. All right, so if the market is trading lower, okay, and let's say we have a swing low down here, and we have this here. This is going to be sell side liquidity, and then we also have another sell side liquidity. This is a swing low there. So let's assume the market was coming lower, expanded higher, created this bullish fair value gap. This is going to be a sell side liquidity, and it will draw the market there. Okay, exactly. So Kyle, bro, that's awesome. Exactly what I was looking for. The first type of liquidity is called internal liquidity. Okay, and then the second type of liquidity is called external liquidity. Kyle, thank you. Okay, because this is a part of my journal, and I think I would have, I might have forgotten to like mention this, but that's awesome, bro. Okay, the first type of liquidity is called internal liquidity. Second type of liquidity is called external liquidity. Now, let me tell you the way the algo prices the market. The algo, and I've said this a couple of times before, I'm sure you guys remember this, but the algo prices the market from external liquidity into internal liquidity and from internal liquidity into external liquidity. Let me explain real quick. If you're buying at a discount, a bullish or a value gap, where do you expect the market to trade up into? Isn't it old eyes, short term old eyes? Is that what you're looking for? If you're bullish and you're buying inside a bullish or value gap at discount, what will you logically expect the market to trade up into? Old eyes, correct? Exactly. And those old eyes is what we call external liquidity because they're outside our daily range of execution or of trading, right? And that's what we have right here. So before we go into what balanced price ranges are, it's important that you understand the different types of liquidity. There's external liquidity and then there's internal liquidity. Okay, and the external liquidity is all lows, hold highs, and the rejection blocks, right? Those are the only elements that constitutes external liquidity, nothing else. Hold highs, hold lows, and then rejection blocks. If we're talking about internal liquidity, that we're looking at volume balances, we're looking at buy some balances and efficiencies, we're looking at redeliver balances, we're looking at fair value gaps, and we're looking at actual market gaps. Those are the things we're considering when we're dealing with internal liquidity. Now, hopefully that makes sense. Let me remove drawings. Now, how do we come about what BPRs are? Now, there's something called the island reversal, and this is more common in more traditional markets like treasury markets, that's the bond market, and commodities, okay? Because they are real asset classes and they're not as liquid, if I show you that way. They're not as liquid of an instrument as the currency markets are. And then you're going to see certain times where they do something like this. Let me use a tool. Brush. So let's assume the market is going up. Okay, bullish candle here. Market expands to the upside. All right, bullish candle. Then what will happen is the market will gap. All right, so the market is going to gap to upside and then continue the expansion. And usually, if it's gapping before a terminus, which is a predetermined level of target, we call it an exhaustion gap. Okay, and then it gets our target there, high time frame premium, and then it does this. Sorry if my drawings are very mundane. This does this. Okay, and then does this. Now, this is more common in more traditional markets like treasuries markets and commodities. So you can go on barter.com and look for, you're going to see this often on commodities market. Linox, cattle, orange beans, sorry, oranges, um, soybeans, and all those, cotton, right? So now this is what we call an island reversal. What the market did here is this is an actual market gap. The market actually gapped this price, Then when it was traded on the downside, it actually gapped that price again. Okay, this is what we call island reversal. Now on currencies, this gap is going to be seen as a bullish fair value gap. This gap down is going to be seen as a bearish fair value gap. Now, what that indicates in that region of price is we have the market deliver on one side buy side liquidity, the other side sell side liquidity, right? Now, what is the importance of BPRs in our trading? Now, usually BPRs have a very fixed rule. If we're using a BPR for an execution, we don't want to see the market trade on a closing basis past the 50% of the range. What do I mean by the 50% of the range? So once you identify a BPR, okay, in this example, we're going to identify uh, this. Let's use this for example. Let's say this is a BPR, okay? All you're doing is you're looking at the consequent encouragement of that BPR, which is the 50%. So whenever I say consequent encouragement, I mean 50%, right? Usually the market will give offer institutional venture drill and immediately reprice. Now, what is the importance of BPRs? In terms of market delivery, the way the algo reads what a BPR is that it's going to read that as a balanced portion of price. Now, let me take you back to the basic understanding of price delivery. Okay, let's take everything back so it makes sense. What is the basic understanding of price delivery? Right? The market seeks two things in price. Can anyone tell me on the chat box? There's only two things the market seeks in price. And all our analysis is based off of this characteristic. It's a characteristic in price. Market seeks two things in price. Exactly, liquidity and efficiency. That's all the market is looking for. The market is looking for liquidity and efficiency. That's what it's looking for. Okay. Now, a balanced pricing is an area of market efficiency. Okay. So let me go and see if we can actually find examples of BPRs. So again, think about that island reversal I talked about. Let's go and look at let's look at the index market. Okay, this is the Nasdaq. All right, let's see if we can go. It should be very easy to spot the BPR on this. So I want to see. We want to go to. I want to use the daily time frame. Okay, daily time frame, daily time frame, daily time frame, daily time frame. All right, so I'm gonna use this. Okay, so here we have the market run above the short term high. All right, market runs lower. We have everything's here. We have a journal liquidity at discount. So identify the journal liquidity at discount. There, that's the journal liquidity. Okay. Now we have the market. Again, remember that on reversal pattern I talked about. The market is running up into liquidity, which is our time frame premium. Okay. Gaps up. Now, if this was an actual futures contract, this will show up as an actual gap. This candle will show up as an actual gap if this was an actual futures contract. Now, remember, we're using the principles of market delivery, which is efficiency and liquidity, right? Now, we have a gap here because of the way the market balances out the gap. So what we're looking for is we're looking for one passes. If we see an inefficiency and then the market completely rebalances through, okay, listen to what I'm saying closely. Rebalances, if we see a buy side, or if we see bullish for a value gap or buy side balance also on efficiency, and then the market completely rebalances through that buy side balance also on efficiency, that makes this a BPR. And this is the characteristic of what we call a change in delivery state. It's called an algorithmic change in delivery state, meaning we've changed order flow. We've changed order flow from bullish to bearish. And if you could trade this on lower time frame, like the 1 minute time frame, the things you could do with this on the 1 minute time frame, I'm telling you from experience, you're like a god. When you know all these things, you're a god on the charts. Do you know how it feels making 40% return per day trading 1 minute time frame? All right, that's how I felt November, and I was like, what the like, wow. Okay, you're absolutely blown away from what the market's doing, and these are the it's just understanding the principles of market delivery. Okay, so all you gotta do is take out the range of the new sales line balance by efficiency, extend it out. Okay, that is your sales line balance by efficiency. But the actual BPR is this. This is your BPR. Unlike the fact that this is still thick here. Reduce the opacity. All right, someone wrote on my. Okay, guys, one of the rules, Isaac. Guys, one of the rules on my session is you never write on my screen. Okay, that is extremely disrespectful to me. Okay, Isaac, that's one of my rules, and that's why I stopped doing. At the start of the year, I was doing live sessions on Twitter. I was doing daily market forecasts and live session on Twitter, and I stopped that because someone wrote "nigga" on my screen. That's the N word, okay, and that's extremely disrespectful. So I don't allow anyone to write on my screen now because it's you guys on Discord. I usually forget to disable annotations. Please, okay. All right, Kyle. If you find your example, please post on the Discord. I'll check it out too. Thanks, bro. So now, oh man, you distracted me. No, you, Kyle. It's I think it was Isaac. Okay, so what we're looking for is you don't want to see the market trade past the 50% of the range. Uh, and look at what the market does. See what the market does. Trades up into this, and what you do in this example is you short the institutional influential drill of the sell and bounce back efficiency. There's going to be sometimes where it does not even get into the actual BPR itself. Okay. Oh, okay. Isaac, you're good. You're good, bro. Bro, you're good. It's fine. It's fine. Is a week 30 to 50% still valid? Yeah, if the market weeks 30 to 50% still valid. What I'm seeing as a rule is closure. Okay. Listen, you don't want to see the market close above the 50%. Now, why is this important? Why is this important for your trading? You want to look at BPRs like you look at immediate rebalances. Now, when you see immediate, remember the last session we did on Euro on I think that was on Tuesday. And I asked you guys what should happen next when you saw the immediate rebalance. And what did you guys see should happen next when you saw the immediate rebalance? Anyone tell me? When you see an immediate rebalance, what should market do next? Exactly when boom. So now when you see BPRs and there is an underlying liquidity, what should you do next? It goes boom. All right. I like the person said it goes boom. I think it was Fico. Yeah. I think I'll start using that word. I want to see it go boom. All right. So what we're looking for next is it should go with speed. Let's see the replay and see how fast the market prices. So what the market does, all right? Market goes boom. Trades up into this expansion. Now watch this. As the market trades up into this, see how the market trades up into this. Think about the island reversal pattern I talked about. If this was a futures contract market, this scan is not there. This is not there. All you see is gaps up, gaps down, and you see this. All right, there's a gap here. There's a gap here. So you only have one, two, three candles. And that's what we call the island reversal pattern. Why is it called island reversal pattern? Remember, an island is surrounded by water. That's the same thing with this. All right, it's surrounded by nothing. So, but on currencies or when we're trading cash market, it's going to show as the buy side balance loss and efficiency. Sell side balance buy side efficiency. This is a BPR. Okay. Now remember, the market sometimes will not even trade into the BPR. Once it trades above the candle that makes the inefficiency, that is your sell. And look at what happens next. BPR here, BPR here. It does the same thing as major balance down into our sell side liquidity. This is a buy side balance by efficiency, sell side efficiency, but it's also sell side liquidity. Just like I taught you guys, right? They're a form of a market inefficiency. Okay. All right. We got we're back to those. All right. Yeah, we can call it the boom candle. So you can call them your balances and BPR as the boom candles. All right. So that's what the market does there. That's the BPR. And if you have any questions, let me know. So BPRs are really easy and straightforward. Like there's nothing really complex about what BPRs are. It's just straightforward. Like the understanding of BPRs are straightforward. Now, there are some times, which I've explained, there are some times where the market will not even trade into the BPR itself. That's why you always go for the sell sign of balance and efficiency if you're selling, or the buy sign of balance sell sign efficiency if you're going long. That's what you're looking for. What BPR does is it indicates a change in delivery state, meaning the algo has shifted delivery based off of institutional accumulation or distribution, right? So as we run above this high, right? Now, if we run above this high, what's going to be the telltale sign that we should reverse, most likely? Let me ask you guys a question. When we run above the short term high on Nasdaq, what would have been a telltale sign that that we're most likely going to reverse? It's I'm just looking for one word. SMT. You guys are awesome. You guys are freaking awesome. Now let's go and compare against the S&P market, okay, and compare against the Dow. And let's see what the market presents us. All right, as we run above this high, if you look at the candle closes, so let me just use candle closes or closures. Awesome. Our Nasdaq is making lower highs. Our S&P is making equal highs, and then the Dow is making higher high. Okay, so at a resistance after another short-term high, we can see very clear, obvious S&T divergence at the highs. Now, if you're not confident, excuse me, if you're not confident enough to sell short, all you need to do is find the inefficiency at discount. This is the inefficiency at discount. Does the market trade through the inefficiency? The market trades through the inefficiency with one solid down candle. Now remember, if we're looking for continuation to the upside, if it gets down here, it at least has to wick through, right? If it trades down here, it has to be responsible. Think about the way we utilize fair value gaps. If we're using inefficiencies for our executions, what do we like to see the market do? We like to see the market, if we're buying, want to see the market trade down there and then close above on a closing basis, or close above the 50%. Isn't that one of our protocols when we're using fair value gap, guys? Yes, so BPR can be used more than once. It can be used more than once, but anything more than twice is not good. But if you're using if you're a value gap, you can use it multiple times. But for BPR twice is fine. Okay, if it shows up into you twice and then it wants to show up into you the third time, I'll ignore the BPR and then I'll look at the other block. I will no longer look at the BPR anymore. That's usually what I do. Because BPR should have the same effect as immediate rebalances, meaning they're points of interbank delivery and they should be explosive. Okay, they should deliver explosively. That's what we're looking for. Does that make sense? No, no, no. So the thing with BPR is you want to see how we trade through inefficiency. BPR is purely inefficient. Is purely imbalance driven, right? That's what BPRs are. So if we are at a discount, the market's trading down into a bullish or value gap. What should be yours? Sorry, give me 1 second, real quick, guys. All right, sorry for the break there. Yeah, so if we're looking for a BPR, we're looking at the way the market trades around 8 points of inefficiencies. So if our assumption up here is we want to say reversal, but we're scared to go short there, then all we're looking for is does the market trade through the fair value gap and does not respect this. Remember, go back to our definition of order flow. All right, order flow is the way the market respects primary rates or discount rates. So this is a discount rate. If we see the market trade through this at a discount, it shows no willingness at all to respect buy side. And that's why I call this a change in delivery state. We've changed delivery state. There's no BPR if the fair value gets. Then, okay, someone asked the question, what if the market trades through and consolidates there and then eventually breaks down? Like it does not trade on one pass. If the market does that, okay, if the market trades down into the fair value gap, consolidates a little bit, or it takes multiple candles to trade through, I don't look at that as a BPR. I look at that as a reclaimed buy sign of balance, sell sign efficiency. So there are different things, okay? So if this candle had done it on three different candles, this is no longer a BPR. This becomes a reclaimed buy side balance, sell side efficiency. So let me type it out for you guys real quick. Reclaimed BC, okay? Or you can call it a reclaimed fair value gap, okay? That becomes a reclaimed fair value gap. Now, the protocols for reclaimed fair value gap is different from that of a BPR. In this example, the market can completely close in on this and it's still valid, okay? But for BPRs, we don't want to see closures. Does that make sense? So that's the difference. If it does not do this on one pass, meaning it does not really show that quickness in wanting to shift delivery state as we want to see. So that makes us a reclaimed fair value gap and not a BPR. So that's the difference. Awesome, bro. What's the difference between reclaimed and redelivered? So this is going to be called redelivery. So the moment we trade through, or the moment we trade down, sorry, the moment we trade down into this is called redelivery. The moment we trade through, this is called a rebalance or rebalancing. So the act of the market trading down there is redelivering, okay, the inefficient delivery there. Once it is traded completely through that inefficiency. That might not even necessarily need to trade through. The fact that it completely closes that inefficient delivery, that's called a rebalance, right? It's rebalance that inefficient portion of price. Okay, remember this is an imbalance. Let me go back to the definition. Go back to the basic definitions. Okay, this is an imbalance. If we completely balance this out, it becomes a rebalanced area. Okay, if we trade down there, that is called a redelivery. So now you say, what's the difference between reclaimed and redelivered? There are two different things entirely. Reclaimed only comes after we've rebalanced an inefficiency. That's the only time you get reclaimed. Okay, it's only after you rebalance an inefficiency. If we have not traded down here and then we gap down, let's assume we gap down, okay, to this, we created a volume imbalance and this candle does not exist. The market trading up here is going to be called redelivery, all right? If it trades up here, it's redelivery, not reclaimed, okay? It's being redelivered into an old fair value gap. But if this candidate is traded third, this already is balanced. Or if we have multiple candidates traded third, that already is balanced. So reclaimed are for balanced areas of inefficient deliveries, if that makes sense. I don't know if that makes sense. Hopefully that makes sense. Exactly. That's what rebound can be reclaimed, of course. So redeliver on first past third. No, 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 not first past third. The act of the market trading down there is called redelivered or redelivery. Okay. Now it can trade down to only a portion. All right, of the fair value gap. So let me look for an example. All right, so this will be called redelivery here. All right, as soon as the market trades up into this, look at the way the market is not completely closing on the bearish value gap. So this is redelivery. The market is being redelivered to a bearish value gap. But as soon as the market closes it here, this is called a rebalance. This is called it's rebalanced because all it's done is it's balanced this inefficient delivery price. Here it only partially balances the inefficient delivery price. So that's what's called redelivery. Here it completely balances that inefficient portion price. So it's called a rebalance delivery. Okay, so this is a rebalance delivery there. Then obviously this is a BPR. Then if you don't see the market trade on one pass and it does so multiple passes or it consolidates there and then expands, that becomes a reclaim for your value gap. So that's the difference. No, no, no. If the market is a fair value gap second to third time, still the same as a reclaim for value gap. It's the same thing. It's not recapitalized or anything. It's just the same. It's being reclaimed. It's being utilized multiple times. So reclaim for value gap. In this example, as we trade down here through this fair value gap, all right? As we trade down there. The trade down through this by some bounce also efficiency on one candle. We don't do it on one candle. Okay, look at this. We don't do it like this where we trade through on one candle. Right? It's done. We do it multiple times. This candle does not close below this. And this next candle opens up, and then trades below this. So this is not a BPR unlike this. This is a reclaimed fair value gap. And remember, I mentioned the difference between reclaimed fair value gap and BPRs. All right, reclaimed fair value gap can get completely filled, and they're still valid. So look at what the market does here. Now, granted, it gaps up a little bit, but it trades down, and then look at this. The market respects the reclaimed fair value gap and then sells off. So that's the difference. Okay, that's the difference. So this we will call redelivery. This we will call rebalancing. This we will call reclaim. It's being reclaimed for new sales or for new distributions. Clean P on E this morning. Okay. All right, so let me close out the